Hello, my name is Andy Barkey, and I'm the publisher of the Think to Retire newsletter. And thanks for joining us for what I call our What and Why video, where I want to describe a bit in short order about what our newsletter is about and why I believe it creates value for you and your financial future. So let me go ahead and get started real quick. Okay. The Think to Retire newsletter is really a digital monthly investment retirement newsletter, which is designed to keep you on top of what's happening in the world and what's happening in the markets, whether you have a 401k, a 403b, a brokerage account, or many other types of accounts. Think to Retire is designed to provide you ongoing asset allocation suggestions based on the type of account you've got. Now, some of the things you'll also get with the newsletter, besides the newsletter, which comes every month, it drops in your inbox the first business day of the month. You're going to get a weekly market review of what's happened in the market the past week and what looks like is going to be going on and some of the things that may be affecting the market in the upcoming week. Just a real quick read to kind of keep you up on what's happening. We have a monthly webinar. It's usually the second Wednesday of every month, but that could change. We'll keep you posted on that if it does. It's designed to look at what's happening in the world again and some of the things that can and will affect your money. So you're just aware of what's happening out there. We also talk a lot about the newsletter, what it's designed to do, the ways to get the best out of it. We want to make sure that you understand the philosophy behind the newsletter and the best way to use it so your experience and your outcomes are the best they can possibly be. But we also have individual demos, individual phone calls that are more done for coaching purposes, which again are designed to show you on a one-on-one basis the best way to use the newsletter. So again, you can use it the quickest, most seamless way, and again, have the best outcomes. Okay, there's two basic models that are in the Think to Retire newsletter. One is the adaptive investment allocation. The other is a dividend income model. I'll refer to them as AIA and DIM from now on. So there's also more detailed videos of these models in our video library. So you're welcome to go look at that and maybe get your head around it a bit more. Or you can just set up a coaching call. We'd be happy to go through it one-on-one with you on the phone. Okay. AIA's goal is really to kind of keep you on top of your money. It's designed to reduce your volatility. That is its biggest goal, is to help you reduce risk and volatility. And again, do that without sacrificing the long-term growth that you want over the long run. We have risk indicators, which are designed to hopefully keep you in the market when the market looks strong and back you out when the market looks like it's starting a declining phase. Again, we don't want to ride the market up just to ride it down like so many people and so many advisors do. Another one of its goals is a newsletter is to reduce your costs. There's a video on what the costs are. There's different levels depending on how you want to use the newsletter. But let me just safely say it's extremely inexpensive. And we try to put it together so anybody can use it, anybody can afford it. And if you're a husband and wife, doesn't matter if you have one account or you have 10 accounts between you, it's one subscription fee. So again, we're trying to keep it extremely user-friendly so you can keep more money in your back pocket. Okay. Let's go through AIA real quick so you get an idea. And again, you can watch the video. It's also on our in our video library to get more details. But really, it's a rotation service, which is designed to look at the sectors, the asset classes, the industries that the market contains, and basically judge them and put them in a ranking order, which ones are the strongest and which ones are the weakest. And the idea is on an ongoing basis to show you the stronger areas to be in and keep you away from the ones that are weaker. And by doing that, we want to hopefully improve your rate of return. Markets consistently change. What works today may not work tomorrow, may not work 6 months from now. So constantly getting the newsletter with the newer allocations based upon which areas are showing the best strength will keep you ahead of that curve. Again, there's risk indicators that work in conjunction with this. And again, this is all done, all this heavy lifting is done behind the screen or behind the scenes. And you will just have to apply the changes to your accounts when they come in as an email in the newsletter every month. Now, it's a good time to say, I guess, we do not put the changes in. We provide you with the information. You apply the changes to your accounts. We don't have control of your account. We don't have access to your accounts, nor do we have any information about your usernames or passwords at all. That's completely yours. We're providing you the information. you can make the changes. And we've set it up in such a way where it can literally be done in maybe 10 or 15 minutes a month. Very easy, very cost effective, very simple. Okay, this is a chart going back, an historical growth chart of the AIA moderate growth portfolio. Now you can use AIA pretty much any way you want. You can be your complete portfolio. It can be half your portfolio, half your 401k, half your brokerage account, or 10% of it. It just depends on what kind of risk you feel comfortable with. This is a moderate growth model, which is 60% using the AIA suggestions. The other 40% is sitting in cash, short-term bonds, or fixed accounts, not in the market at all. And you can see the growth difference. The gray line is the S&P 500. The blue line is the AIA moderate growth model. You can see the returns are quite a bit better. Over that roughly 20-year period from 2001 to 2020, the S&P 500's returns were just shy of 7%. The AIA moderate growth returns were over 12, almost 12.6%. Quite a bit better over the long run. And you see the dollars associated with a $100,000 illustrated investment. Now, what I think is actually more important than the growth, more important than the rate of return, is the risk control, because this actually plays into helping the growth work better. And again, we believe if you can take some of the risk out of it, if you can reduce the downside, the upside is just that much more easy to attain, and your long-term return is just that much more easy to actually grow and experience. Now you can see the brown areas in the loss exposure profile, actually the gray areas, that's what the S&P showed as a volatility. Back at the early part of the century, back in 2000, 2001, 2002, that's when we had the dot-com bust, and 9/11 was all baked in there. The S&P was down about 40% over that period of time. The other big drop was in the mortgage meltdown, was 2007-8, and finally ended in 2009, and it was down over 50%. You can see how the blue area, it's hard to see there, but the AIA allocation was so much less volatile. And again, just for example, this dip, which is a little hard to see where my cursor is, that is over a 50% dip in the S&P, and that's the mortgage meltdown. Well, the risk indicators helped back us out of that before things got very bad at all. So we rode that out, didn't take the downside. And by doing so, we didn't have to gain back all those losses before you're back in positive territory. So that in itself assists in the long-term growth. Now over here to the maximum drawdown, this is kind of important. The worst drawdown, the worst loss that the S&P took over that period of time was at right around 2009, the mortgage meltdown, and it was down over 55%. The worst loss the AIA moderate growth experience was back in 2010, and it was 9.9. So quite a bit more loss reduction, more volatility control, and that in itself helps enhance growth over the long run. Okay, let's switch and talk about the dividend income model. It's a different model completely, and it works completely different. It's designed for income, for investors who want income. It's built around 15 to 20 common stocks. They're picked for their dividend paying level. They're picked for their consistency of dividend and hopefully their dividend growth. It doesn't change very much. It doesn't change every month like the AIA model could do. And again, I got to say that dividends, while a lot of companies have paid consistent dividends for years and decades, dividends are not guaranteed. But nonetheless, the whole idea of the DIM model is to get you a better than average, ongoing, monthly, quarterly cash flow. As we know, a lot of people, as they're nearing and entering retirement, want that cash flow from their 401ks, IRAs, or other investments just to help them pay for their lifestyle. Okay. And again, we're trying to basically have consistent income. We're constantly going to be upgrading the stocks whenever it's necessary. We'll send you out an alert if we're getting rid of a stock or two for various reasons and replacing it with others. We'll tell you which ones to get rid of, which ones to replace. And again, you go to your accounts and just make those changes. And it's all one management fee. You get both of these models with one subscription cost. As I mentioned, if you're you and your spouse, you can have multiple accounts. You're still just paying one subscription fee. Okay. I mentioned this a little bit earlier, but I'll go over it because we're just about done with our short video. The newsletter is mailed to you the first business day of the month. Expect to drop in your inbox. It'll have the allocations. All you have to do is look at them There'll typically be maybe 3, 4, 5 different allocation suggestions, mutual funds, exchange traded funds. You can just go to your account and make those recommended or suggested changes. There's alerts that come out. If one of the risk indicators ticks off, and that indicates we need to back away from the market, or if we're out of the market and the risk indicator indicates buy, we want to go back in the market. Those are on an as-needed basis. As soon as we get that, we will send you an alert telling you exactly what to do, the funds to get out of and where to go, or the funds to get into. We have the live webinars, which I suggest you go make a habit of going to those, because you'll hear more about how the newsletter is designed, how it works, so you can use it better. And if you'd like to, like I mentioned before, avail yourself of the coaching calls and the one-on-one phone calls with our staff, just to get a better idea of how the newsletter can help you. Now, we recommend maybe you have one of these coaching calls before you subscribe to the newsletter, and by all means have some on as an ongoing training or familiarization process after you become a subscriber. And we built this thing purposefully not to take a lot of your time. You can actually make the changes. I use the same system myself. I make my changes in probably 5 or 6 minutes a month, but I've done it for a while. So it's going to take you maybe a little bit of time, but it's going to be very simple to get to that point where making the changes monthly may take you as much as 10 or 15 minutes. So again, the Think to Retire is designed to just keep you up to date, keep you out of trouble, reduce your risk, save you some money on a whole lot of money on management fees. And again, thank you for joining us. I hope you got a little bit out of this. And by all means, please watch some of the other videos and literally go online and request a demo, request a call, and we'd be happy to sit down and answer your questions. So thank you for your time. This is Andy Barcade. I'm the publisher of the Think to Retire newsletter. Thanks for your time again.